Checking with Anthony DePaul from Atlantic Pacific Securities. He is in our Sydney CBD studio live for you now. Welcome to the program. It's intriguing, is it not? You know, with the risk-on story, we get that rise in the Australian dollar. It's always got that blessing and curse nature to it, though, because we've been talking a lot on central banks this week. But stocks, how do you think they're faring and likely to fare into next week?
Well, I think today we've had 7 straight sessions of gains. As we headed towards the second half of the session, the market pulled back slightly, you know, with some de-risking leading into the weekend, also some profit taking, which is only natural. And, you know, you spoke about the Aussie dollar before. You know, it's been very strong. I think that's actually of no surprise, because a lot of overseas investors, you know, like our yields, and they certainly like the prospects of our resource sector, which have done fantastically as of late.
And do you see that there are, though, potential headwinds, though, just waiting to start blowing the way of that sector, not least of all the old bugbear of overproduction? It's that, you know, it's the theme that we've been on about with energy, but materials, you know, that's borne the brunt of that suggestion as well. Anthony, just on that score, though, the headwinds that would come potentially from oversupply back on materials, and when might we need to brace for that?
Good question. As you know, with materials, the market seems to overshoot on the down and overshoot on the top. Very important to get in at the bottom of the cycle, get out at the top. We usually talk to our clients when we look at profit taking, you know, not being too greedy on the exit. And there's so many companies where their valuations are being questioned at the moment. BHP, Rio, Fortescue Metals, Whitehaven Coal, after having such a good run. And, you know, a lot of that's been on the back of loosening of credit in China. And will that last? Well, they've had property price increases over the last 12 months in some cities of over 50%. So that would have to cool sooner rather than later. And you know, the average prices of, for instance, iron ore in the second half of the year, or second half of the calendar year since 2011, have been around about 15% lower. So we would actually expect a bit of softening in commodity prices, especially iron ore and coal, as we're heading towards the later half of this calendar year.
It's interesting, though, because there are others who are suggesting that you'll need to continue the through train of credit flooding the system, specifically the total social financing, which is the broadest measure of credit through China's economy. You're saying, what, that there's been too much already and there will be a pullback. If they do that, though, Anthony, how do they hit their GDP forecast for the year?
Yeah, that's right. So as we know, the GDP figure is politically sensitive, and the government will do everything they can to keep it in that range of 6.5 to 7%. And that's of no surprise to the market, and they really are struggling to go to...
Are you okay on that?
Yes,
like, okay. Carry on, Nancy.
They really are struggling to go to a consumption-based GDP figure. So what I'm looking for is some of the concerns in their property market to start to prevail, and some of that loosening credit that we saw to not be repeated. And as we go into the seasonally weak part of the year with the cold season, etc., I think that will have an impact on commodity prices, even if the Chinese government is under pressure to get those growth figures.
Well, growth is keenly sought back home by Woolworths, and we know that they've told us don't expect any standout news for at least the next 6 months. So is it any wonder that this has been a back burner play for so many since those sentiments were sort of transmitted to investors?
Well, it's really surprising, because if you only have to go 2-3 years ago, and investors, their sentiment towards a company like Woolworths and Wesfarmers is, I'm just going to invest in a consumer staple. They sell bread and milk, and nothing's ever going to happen to them. They pay a great yield. And in Woolworths' case, that's been questioned significantly. Their valuations and that sentiment has been questioned significantly over the last couple of years. And we've seen it go from $37 down to a low of about 20.50. And that's really scared a lot of investors in that space. And I think that's actually helped support Wesfarmers, because if you're a fund manager or an institutional investor and you have to have some sort of exposure to consumer staples, with those concerns over Woolworths, you're probably going to reallocate away from Woolworths and into Wesfarmers, and that's why you've seen a huge outperformance between the two names.
And when do we realistically, eye the prospect of that narrowing?
Oh, this is the million-dollar question. I think it actually is starting to show all the telltale signs of a turnaround. If you're looking at factors that you look to identify when picking a turnaround, a big company, that always helps. A liquid company, that always helps. Is a lot of the negativity already out there in the market? In Woolworths' case, I would suggest it is. If we have a look at their Masters program, that's well publicised.
What's happened to that, by the way? On that score, importantly, because you touched on it, where are we at with the sale? There were bidders that were meant to have come forward. That's all been very quietly just put off in any announcement. So why has that happened?
Good point. So they've already done the write-downs. So, the bad news is out. They've done the write-downs. It's hit the bottom line. There could be a few further write-downs to come if they don't get rid of all the inventory and even the costs associated with the potential sale and of not only the business but the inventory. I would suggest, and this is, this could be debatable, I would suggest a company like, and there's been talks and rumours about this in the media already, a company like Wesfarmers, knowing that there's some distressed assets there, may look at some of those assets as value. If that doesn't happen, then it's probably going to result in not a sale and just further write-downs.
And not helping matters, a delay on a determination from the ACCC on who else in the market might have a valid claim on those assets as far as competition continuing and not just simply, as you've said, going the way of the rival.
Yeah, that's right. Well, if we look outside of the grocery sector, there may be other companies that are looking for a big box, if you know what I mean. If we're looking at their warehouses for the Masters stores, they might be looking at a big location in those a big store in those locations where they can provide products to their customers. I'm struggling to think of one that would be suitable at this point. Would it be maybe a retailer that's in the the car space, selling products there? I'm struggling to think of one, but I feel that a lot of the concerns, a lot of the negativity is already out. You've got the Masters program, you've got the well publicised problems with Big W. Also, if you look at sentiment, nearly every Tom, Dick and Harry thinks that Woolworths will continue to go down. And when all that's already out there in the market and you've seen the price go from $37 down to $21.50, that's when I'll be looking to see if there's some value in that turnaround.
Not helped by the fact that they've dropped the tagline, the fresh food people. Seemingly Coles has grabbed that one with gusto and trademarked it, more full Woolies for not doing just that. It's rather confusing, is it not?
Well, you look at Wesfarmers and Coles, they said a while ago, down, prices are down. Little did the market know at that time they'll be referring to Woolworths' share price. But moving forward, if we look at Coles or Wesfarmers, they've gone into Homebase in the UK. Now, they've spent about $700 million there with
chicken feed.
Another $1 billion looking to be invested over the medium term. And there's concerns around whether that was the right move, especially with the concerns with Brexit and the impact that could have on consumer spending and also renovations, the renovations market with the property market. So could that be a huge concern for Wesfarmers moving forward? And if it does happen to be a huge concern, you might see the tables turn. You might see fund managers and institutional investors do a reallocation of capital away from Wesfarmers into Woolworths.
Even on the strength of it being, well, it's just such a small balance sheet impost though for Wes to be doing. It's not material to the bottom line. I mean, I know you've said that there's another $1 billion lined up, but you look at their quarterly and annual profits. This is accounting error territory.
Yeah, so the earnings for Homebase, I think it comes in at $40 million EBITDA, earnings before interest and tax. So it's not substantial. They've only spent $700 million on it. However, if conditions were to deteriorate in the UK, that could very easily turn from a profit-making business into a loss-making one over the medium to long term. And you've got another drag on Wesfarmers in addition to their current drag in coal, which produced a loss for the first time in 16 years. And all you need, the pressure starts to mount, and if the new CEO of Woolworths starts to turn things around, then it might just be, what is the lesser of the two evils? And fund managers may reallocate capital to Woolworths on that basis.
Okay, listen, thank you so much.
Thank you.
We'll talk to you soon.